We're back with another episode in our Breaking Down the One Big Beautiful Bill series. And today we're talking about one of the most debated changes in the bill: how gambling losses will be treated for tax purposes starting in 2026. Under the new rule, gamblers will only be allowed to deduct up to 90% of their losses from their total gambling winnings on federal tax returns. This is a departure from the current system, which permits taxpayers to deduct 100% of the losses so long as they don't exceed their total winnings. Here's why that matters. Imagine a gambler wins $210,000 and loses $210,000 the same year. Under the current rule, they wouldn't owe anything in taxes because they broke even. But once the new rule takes effect, only $189,000 of those losses could be deducted. That would leave $21,000 considered as taxable income, even though the person did not make a profit. This change could affect both occasional and professional gamblers and has raised concerns across the gambling industry. According to the Joint Committee of Taxation, this adjustment is projected to bring in over $1 billion in revenue over the next decade. Critics have pointed out a major issue. This change could lead to people paying taxes on what's essentially phantom income, money that looks like profit on paper, but doesn't actually exist in their bank account. In response, some lawmakers have introduced proposals to reverse the change. One of them is the Fair Bet Act, backed by Representative Dianne Titus and Ro Khanna. The bill aims to bring back the full deduction for gambling losses and argues that the current cap punishes both everyday bettors and professionals alike. Senator Catherine Cortez Masto has also introduced a similar bill in the Senate called the Full House Act. However, efforts to fast-track the legislation were blocked in early July, leaving the repeal effort on hold for now. Some industry groups are also expressing concern. The American Gambling Association, which had previously supported the broad tax legislation, has since shown support for restoring the full gambling loss deduction. Regardless of the outcome, one rule hasn't changed. All gambling winnings must be reported to the IRS, and losses can still be deducted, but only if you itemize your taxes and only up to the amount of your total winnings. Beginning in 2026, though, that deduction will be limited to 90% for those losses. To claim any gambling-related deductions, the IRS requires thorough records that include receipts, tickets, or a written log with the dates, location, types of bets, and amounts won or lost. So, what does all of this mean going forward? For some gamblers, this change could create tax bills even when they don't come out ahead. And for those who gamble frequently or at high volumes, even a small percentage of non-deductible losses could lead to a significant tax liability. Supporters of the cap argue that it adds revenue and discourages excessive gambling. Opponents see it as unfair taxation on money that was never truly earned. With the new rule set to begin in 2026 and repeal efforts currently stalled in Congress, the gambling community and tax professionals alike will be closely watching how this will play out. Stay informed. More changes could still be on the table.